Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, August 12th, 2026, and we have a packed show this morning. July CPI is out today, Riot Platforms is surging pre-market on a landmark AI deal, and the Fed's rate path is very much back in focus. Let's get straight into it. Lizzie, futures are mixed this morning with CPI dropping today. How are traders positioning ahead of that number, and what's the overall tone on the desk right now?
Morning, Robert. The tone is cautious. Nobody wants to be caught on the wrong side of a CPI print. So you're seeing a lot of hedging and range-bound positioning heading into 8:30. The S&P 500 is technically leaning bearish here, with price pushing right up against the upper Bollinger Band, near 7,753, which historically acts as resistance, and SPY is showing the exact same setup around 773. So the technicals are telling bulls to be careful about chasing at these levels. The broader read is that this market needs a dovish surprise in today's inflation data to break higher with conviction, and without it, the path of least resistance is probably a pullback from these stretched levels.
Oil is a big part of why inflation fears are back. Brent is sitting near 87.75, up over 12% from last week's lows. How much is that crude move complicating the picture for equity traders?
Quite a bit, Robert. The four-session rally in crude tied to US-Iran tensions around the Strait of Hormuz is directly feeding into fears that today's CPI could surprise to the upside on energy, which is exactly what the market doesn't want to see. Energy inflation is the kind that's hard to dismiss as transitory, and when you layer that on top of Cleveland Fed President Hammock warning that multiple rate hikes may still be needed to reach 2%, traders are being forced to reprice September Fed meeting risk in real time. The market isn't fully panicking, but the risk premium being assigned to equities is measurably higher than it was a week ago.
What are the key earnings reports traders need to have on their radar this week?
Three names stand out this week. CoreWeave reported yesterday, that's the AI cloud infrastructure name, and revenue around $2.6 billion was the number the market was scrutinizing, given how aggressively the AI infrastructure build-out is being valued right now. Today, after the bell, we get Cisco, with estimates around $1.17 in EPS and $16.8 billion in revenue. Cisco has been quietly repositioning around networking for AI, so any commentary on enterprise AI spending will move the broader tech sector. Then Thursday, we get Applied Materials, and with the semiconductor space under pressure recently, an EPS beat near 3,039 on roughly $9 billion in revenue could provide a meaningful lift to chip equipment names. On the bigger picture, JP Morgan just raised its year-end S&P target to 8,000, with a $365 EPS forecast on the back of AI-driven earnings growth. That's a notable fundamental call, but when price is already pressing the upper Bollinger Band technically, you have to respect the setup and not chase the headline.
The headline mover this morning is Riot Platforms, up nearly 18% pre-market on a $9.1 billion 20-year AI data center deal with Anthropic. Is this a Riot story, an AI infrastructure story, or does it say something bigger about where crypto miners are heading?
It's both, Robert, but the bigger story is structural. Riot is confirming that the smartest play for Bitcoin miners with cheap power and existing infrastructure is to pivot toward AI data center leasing. And the $9.1 billion over 20 years from Anthropic validates that thesis at scale. CleanSpark is up about 4% and Hut 8 around 3% on sympathy. And while there's a real trade in those names today, I'd be selective. Riot has the Rockdale, Texas facility and its AMD relationship that gives it a differentiated position, so sympathy bids in smaller miners may fade faster. On the other side of the ledger, on holding falling over 15% on a revenue miss and citing tariff headwinds, and a weaker consumer is worth taking seriously as a sector read. That's not purely company-specific, it's a signal that the premium athletic consumer is being pressured, which has broader implications for consumer discretionary heading into back-to-school and holiday planning.
Steve, CPI for July is out today. The June reading came in at 303.95, below the prior forecast of 334.7. What are traders watching most closely in today's print, and what would a surprise in either direction mean for the Fed's path?
Robert, the June CPI reading of 333.95 was genuinely encouraging because it came in below the forecast of 334.7 and below the prior reading of 335.12, which gave markets some breathing room heading into the summer. What traders are watching most closely today is whether that softer trend holds in the July data, particularly given the surge in energy prices over the past week, with Brent crude up over 12%. A reading that matches or comes in below June's level would be a meaningful relief for markets and could reduce the probability of a September rate hike, while an upside surprise, especially if driven by energy, would validate the Fed's more hawkish messaging and likely push Treasury yields higher from the current 4.7% on the 10-year.
PPI hits tomorrow and retail sales Friday. With the Fed already squarely in focus, how important is that 1-2 punch of data for rounding out the inflation picture this week?
Very important, Robert. PPI tomorrow for July will give us the upstream price pressure reading. It's the pipeline indicator that tells us whether the inflation softness at the consumer level is durable or if producer costs are building in ways that will eventually flow through to consumers. Then retail sales on Friday will tell us whether the consumer is still spending despite the rate environment. And with the consumer confidence index holding at 55.2 in July, which beat the 54.0 forecast and was a solid improvement from the prior 49. There's a reasonable base case that spending held up in July. Also worth noting, jobless claims come out tomorrow as well. Forecast at 202,000 against last week's actual of 9,000, which came in better than consensus, so the labor market is still holding in despite the macro noise. Taken together, this week's data flow is essentially a full inflation and consumer health checkup, and the Fed will be watching every print closely.
Lizzie, let's flip over to crypto. Bitcoin has now failed for the fourth time this year to hold above $64,000, and it's sitting nearly 50% below its all-time high. With macro headwinds mounting, is there a credible bull case here?
Technically, BTC is in genuinely neutral territory right now. Momentum indicators are sitting right at the midpoint between buyers and sellers, with a faint bullish lean in the trend signal, but nothing decisive enough to act on directionally. The macro headwinds are real. Potential rate hikes reduce the appeal of non-yielding assets, the US-Iran impasse is driving risk-off flows, and Michael Saylor's strategy selling its Bitcoin holdings has been a notable sentiment overhang. The credible bull case rests squarely on today's CPI print. A softer-than-expected reading would reduce September rate hike odds and potentially give Bitcoin the macro tailwind it needs to make a genuine run above 65,000 with conviction. Until that happens, BTC is firmly in wait-and-see mode, and traders should respect the range rather than anticipate a breakout.
What about ETH and Sol, and where does XRP fit into the picture right now?
ETH is also sitting in neutral territory technically. Momentum is balanced with a slight positive lean, trading around 1,288, so similar to Bitcoin. No strong directional signal. Ethereum's staking yield of around 3.1 to 3.3% is an interesting differentiation from Bitcoin in a rate-sensitive environment, and Ethereum ETFs actually outpaced Bitcoin ETF inflows for 3 consecutive weeks in July, which is a data point worth monitoring. Solana is around $76 with a neutral read as well. Momentum is essentially flat with no strong signals firing in either direction. Firmly in wait-and-see mode, and XRP is the most concerning of the major names. Back near $1, its lowest since November 2024, with ETF inflows collapsing from nearly $132 million in May to barely $1 million so far in August. And the Clarity Act appearing unlikely to pass the Senate this year, given the legislative calendar. There's no meaningful near-term catalyst that changes the XRP story. And with institutional inflows drying up this sharply, it's a name to approach with significant caution until the regulatory picture genuinely clears.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.